Hello and welcome to MLC's analysis of the 2015 federal budget. My name is Peter Hogan, Senior Technical Manager, MLC Technical Services. In considering what was and what wasn't in this year's federal budget, I will concentrate on four key areas. Firstly, personal taxation. Secondly, superannuation. Thirdly, social security. And lastly, small business. No significant new measures were announced for personal tax that had not already been announced in last year's budget or announced ahead of the formal release of the budget. No changes to the personal income tax rates, Medicare levy or FBT rate were announced, including the budget repair levy, which will apply for another 2 years. With the increase of Medicare and the repair levy, taxpayers at the highest marginal rate will continue to pay a combined income tax and Medicare levy of 49%. Eligibility for fly-in, fly-out workers to specialist zone tax allowances will cease as of 1 July 2015. Temporary residents will lose access to the general exemption tax thresholds from 1 July 2016. And simplification of the calculation of work-related motor vehicle expense deductions will apply from 1 July 2015. The government has again stuck to its commitment not to change the broad framework of superannuation in this budget. Only minor changes to remove red tape from procedural and reporting requirements were announced. The Assistant Treasurer did, however, make welcome announcements prior to the budget of changes to the condition of release for terminal illness superannuation benefits. The 12-month eligibility period has been doubled to 24 months, effective from 1 July 2015. This will give terminally ill members earlier access to their superannuation. Following on from previous announcements to defer the increase of superannuation guarantee contributions to 12% until 2025, the super guarantee rate will still remain at 9.5% until 1 July 2020. It will then increase by 0.5% a year until 1 July 2025. As announced prior to the budget, changes to the asset test threshold and taper rate for the age pension are intended to apply from 1 January 2017. For a couple who are homeowners, entitlement to receive a part pension ceases at assets other than the family home of $823,000 or more. Importantly, those age pensioners who lose entitlements due to these changes will be eligible for the Commonwealth Seniors Health Card. At the other end of the scale, a couple who are homeowners can now have assets of up to $375,000 before the taper rate applies to reduce their entitlement, up from $286,500. Changes to aged care means testing for new residents entering aged care from 1 January 2016 will effectively remove the rental income exemption for those residents paying for their aged care accommodation costs by periodic payments. As promised, the tax rate for small businesses operating as companies was announced to be cut by 1.5% to 28.5%. In addition, a concession for small unincorporated businesses was also announced of a 5% tax discount, up to a maximum of $1,000 per annum. In addition, any assets acquired by small businesses between budget night and 30 June 2017 and costing less than $20,000 will be eligible for an immediate deduction. Notably missing were any references to significant changes in relation to superannuation, taxation, gearing within superannuation, negative gearing into property, or changes to income streams available to retirees. All of these will no doubt form part of extensive discussions and examinations as part of a number of reviews announced by the government, which are due to report later in the year. For more commentary on the federal budget, go to mlc.com.au.